Most people look at today's market and assume it's business as usual. The headlines bounce around. The S&P feels like it keeps finding a way to recover. And if you've already saved over $1 million, it's easy to think, I just need to stay invested and I'll be fine. But the market environment is quietly changing. It's shifting from strong and supported to more fragile. And when you're nearing retirement, fragility is the thing that you can't afford to ignore, because small cracks can turn into expensive mistakes at exactly the wrong time. I'm Justin Kuntz, a certified financial planner and managing director of Pacific Wealth Management. And in this video, I'm going to show you what's exactly happening under the surface of the market right now and what it means for your retirement plan. Specifically, we'll cover 3 things that almost never get explained clearly, but can make or break your outcomes in the next phase. First, the momentum illusion, why the market can look healthy on the outside while the internal strength is fading, and how that can set up investors for a surprise. Second, the pressure points that are piling up at the same time, slowing growth, housing strain, energy costs, and mixed inflation signals, and why multiple moderate risks together can create a very different environment than one big obvious risk. And third, the retirement investor response, how to adjust without panic selling, without trying to outsmart the Fed, and without accidentally turning normal market volatility into permanent retirement damage. Let's start with what most investors miss. When people say the market is doing fine, they usually mean the index is up. But an index can be up while the market underneath is actually getting weaker. Think of it like a table that looks stable because the center is holding up, but 2 of the 4 legs are starting to crack. You can still set dinner on it for a while until the wrong bump hits at the wrong time. That's what's been happening with market breadth. Market breadth is just a fancy way of basically asking how many stocks are actually participating in market gains. In healthier, more durable markets, more durable bull markets, you tend to see broad participation. Lots of sectors, lots of companies, lots of sizes contributing towards that forward momentum. In fragile markets, performance gets concentrated into fewer and fewer names, and the index can still rise, but it's being dragged upward by a narrower group. That's not automatically bearish, but it definitely changes the risk profile. Because when the leadership narrows, the market becomes a lot more sensitive. If a broad market is like a team sport where everyone's contributing, a narrow market is like depending on 1 or 2 star players. And when they're hot, everything looks great. When they're not, the whole game changes. Now let's connect that to what you actually care about, your retirement timeline. When you're 35, you can ride out a lot. If the market drops, you keep buying through your next paycheck. You have decades, and volatility can even be to your advantage. But when you're nearing retirement, you're no longer just an investor. You're a soon-to-be spender. And the market doesn't need to crash to cause a problem for you. A choppy, fragile market that produces lower returns and sharper pullbacks can be just as damaging long-term because it can interrupt the exact years when your plan needs the most stability. Which brings us to the second big shift. The pressure points right now are stacking up. Economic growth is positive, but it's slowing down. And slower growth changes the entire vibe of the market. In a strong growth environment, companies can grow revenues, consumers can spend, and even mediocre businesses can get lifted by the tide. In a slowing growth environment, investors start caring a lot more about what's real and what's assumed. Earnings matter more, margins matter more, debt costs matter more, and the market becomes much less forgiving. Now you throw housing into the mix. Housing is one of those areas that's easy to ignore until you remember how many parts of the economy it actually impacts. Higher rates don't just make mortgages more expensive. They can freeze activity, and frozen activity slows down economic momentum even more. Then you layer in energy. Energy can act like a tax on the entire economy. If energy costs rise, transportation costs rise, manufacturing pressures rise, and household budgets tighten. It doesn't have to be a shock event. Persistent pressure can sometimes be enough. Now here's the part that makes this environment that much more fragile. It's not one big threat. It's multiple medium-sized risks, all hitting at the same time. And that's often how retirement plans get blindsided. Because if you see one obvious danger, you respond, you plan, you adjust. But when risks are manageable individually, people shrug. They often stay on autopilot, keep doing what they've been doing, until the combined effect shows up in the form of more volatility, less consistent returns, more frequent pullbacks, and longer recoveries. And that's before we even talk about the Fed. The Federal Reserve is taking a cautious approach right now. They're holding rates steady while monitoring mixed signals in inflation in the labor market. This is important because a lot of investors have built a habit over the last decade. The Fed will save the market. But what if the Fed isn't in a saving mood anymore? Not because they don't want markets to fall, but because they're balancing competing goals and the data is mixed and also competing. If inflation is sticky in certain areas, the Fed can't just cut aggressively without risking a second wave of inflation ramping up. And if the labor market is holding up, they don't necessarily feel that urgency anymore. If growth is slowing but not collapsing, they can basically afford to wait. So you get a cautious Fed at the end of the day, and a cautious Fed environment can be tricky because markets don't like waiting. Markets like clarity. Markets like a clean narrative. So when the story is rates are coming down fast, investors position for it. But when the story is we're not sure yet, investors get more sensitive, more reactive, and definitely more headline driven. And this is why the same piece of news can move markets in weird ways, because in a fragile environment, sentiment can swing faster than fundamentals. Now, none of this means that you should be out of the market completely. But what it does mean is that a strategy that worked in a strong, stable environment may not be the right strategy right now. And here's the retirement-specific risk that matters most in a momentum-losing environment. It's not just the sequence of returns risk in the classic sense of a big crash right when you retire, but it's what I call retirement friction. So retirement friction is when the market doesn't give you the clean compounding returns anymore. Instead, it gives you up years that are smaller than expected, down years that show up maybe more often than you expect, and recovery periods that feel quite a bit longer. That kind of market doesn't destroy your plan in one dramatic moment by any means, but it erodes it through 1,000 small cuts, especially if your withdrawals are starting soon, and especially if you're drawing from the wrong accounts in the wrong years. Now, if I make this more practical, it might be better to understand. If you saved $1.5 million and you plan to pull, say, 70 grand a year, that's not necessarily a crazy number. But what happens if the market returns are muted for a few years and you're withdrawing at the same time? And you're paying more in taxes than you expected. And maybe you're also helping adult kids or paying for more travel early on in retirement. You don't need a disaster for math to start working against you in this situation. You just need an environment where average returns don't necessarily show up as expected or on schedule. And that's why in a fragile market, the goal isn't to predict what's next. The goal is to make a plan less dependent on being right about what's next. So, what do you do? Here are 3 adjustments I look at with clients when the market momentum is weakening, without turning it into a panic response. Number 1, increase diversification. Diversification allows your portfolio to weather these challenging events because certain things are going up when other things are going down. Particularly if you're in an event where the stock market is decreasing, ideally you have enough diversification to not only lessen the blow of the S&P 500 going down at once because you've got different stock market components within the portfolio, but you also have other things in your portfolio that can go up when that stock market is struggling, whether that's bonds, alternatives, or even income yielding money market funds. Things that can basically move in the opposite direction of the stock market with a negative correlation can smooth out your ride so you can withdraw funds without necessarily punishing yourself long term. Number 2, be more intentional about risk, not necessarily less invested. This is where people get it wrong. They hear a fragile market and think the only smart move is to get conservative. But going conservative at the wrong time can be just as dangerous as being too aggressive. If you slash risk and then inflation runs hotter than expected, you can lose purchasing power quietly. If you over-concentrate into what feels safe at the time, you might end up taking a different risk, like interest rate risk or even reinvestment risk. The question isn't, should I reduce risk at these times? But rather, the question is my current risk aligned with my spending timeline and my need for growth? Because nearing retirement is a transition. You're not flipping a switch from growth to safety. You're shifting from growth only to growth with resilience. And that usually means looking at things like how concentrated you are in a handful of positions, how dependent your plan is on a small group of stocks continuing to lead, and how much of your portfolio is truly diversified. A lot of people learned the hard way in recent years that bonds don't always just stabilize everything in the short run. You have to be intentional about what type of bonds you own. Number 3, build a withdrawal strategy that can flex. In a stable, strong market, people can get away with a simple rule of thumb. But in a fragile market, rules of thumb can get pretty expensive. Your withdrawal plan should have at least some built-in flexibility, so you're not forcing the portfolio to fund the same lifestyle no matter what the market is doing. This doesn't mean that you can never spend, it just means that you pre-decide where flexibility comes from. For example, maybe you keep a travel buffer that's optional. Maybe you adjust large one-time purchases based on market conditions. Maybe you plan Roth conversions in a way that doesn't pile on tax pressure during down markets. Maybe you choose which account to pull from based on tax brackets and market conditions instead of just take it from the IRA because that's what we've always done. In a fragile environment, small tax mistakes and rigid withdrawals can do more damage than a normal market downturn, because taxes and withdrawals are the levers you can actually control. The market is a lever that you don't. And that's what the mindset shift that matters most right now is all about. You don't need to forecast whether the Fed cuts in September or December. You don't need to guess whether housing reaccelerates or stays sluggish. You need a plan that works if the next few years are great and also works if they're just okay. And that's the definition of retirement readiness. So here's the bottom line. The market is losing momentum. Economic growth is still positive, but slowing. Housing and energy are adding pressure, and the Fed is cautious because the signals are mixed. And market strength is narrowing. The fewer stocks are driving the performance while global momentum declines. In the final years before retirement, you don't win by being the most aggressive. You win by being the most prepared. If you want help stress testing your portfolio and retirement plan for this kind of market, where returns might be choppier and leadership might be narrower, there's a link in the description below to schedule a free call with us. We'll look at your allocation, your timeline, and your withdrawal approach and identify the key adjustments that can help you stay confident without overreacting. Because when the market is shifting, the costliest move is usually not the wrong prediction, it's the wrong behavior. Thanks for watching.